Tariffs might sound like something only economists or politicians need to worry about, but when global trade tensions rise, the effects can trickle down fast. From higher prices at the store to swings in the market, tariffs can create ripple effects that directly impact your investments and retirement income. In this episode of The Retirement Engineer, we break down what tariffs really are, how they influence the economy and markets, and why staying informed matters for long-term investors and retirees alike. So, Jim, tariffs, yes, they have been showing up in the headlines again. And for a lot of people, it's not always clear what that really means. So before we go on about how this affects the market or retirement plans, please walk us through the basics. What exactly is a tariff, and why do countries use them?
That's a great question. Anytime you have any topic that shows up so often in the news cycle, and especially one that can affect markets and the economy, it certainly makes some degree of sense to take a step back, do a little bit deeper dive. So at 30,000 feet, the simple definition of a tariff, it's really nothing more than a tax. It's a tax that's levied by a government on goods and services that are imported into said government. That's on imported goods and services. That said, that tax is actually levied and collected by our customs and border patrol agents at ports of call and areas that normally you would transact and receive these goods and services. Governments use these and have used these for many years. The U.S. has a long history of dealing with tariffs. It's not just the tariffs from Trump's first administration or the discussions we've had today. Why companies or countries, I should say, will use tariffs, it really boils down to three key drivers that they would like to affect. The first is some form of protectionism, where the government will establish a tariff in an effort to protect some industry or company within the states. They can do that through tariffs. They can do that through subsidies. You'll see that sometimes with the U.S., especially with agriculture and farming. And they can also do that through quotas and excise taxes. The first time our government ever did that, and you can actually Google it, there's such a thing, the tariff. I mean, we all know this, right? The tariff of 1817, right? That was a big one.
Of course, we knew that one. Yes,
that was the first time the government actually used a tariff in a form of protecting some industry within the U.S. And remember, it was a very new nation. We had just finished the Second War with Great Britain, the War of 1812, and they levied a tax or a tariff on all cotton and wool goods and services that were imported into the U.S. Part of the reason for that is we had a fledgling textile industry, especially in the East. And you've all seen those old brick manufacturing buildings powered by steam with the big sewing machines. And as a result, it was a way of protecting that particular industry. It also went a long way to financing a lot of our early startup with respect to the Industrial Revolution. And having those tariffs in place really provided the dry powder we needed to really excel and grow rapidly. But that wasn't the only tariff we've had. And over time, we've had some really crazy ones. There was one tariff that was instituted back in the mid 1990s. And it was 127% tax or tariff on Chinese manufactured paperclips.
Wait a minute. I'm sorry, I missed this one in class, the Chinese paperclip tariff.
It's a big one. Google it. Oh yeah, it's there. It was to protect our our huge
U.S. paperclip.
U.S. paperclip industry. Now, why did that come about? I have no idea, but I suspect it probably had to do with a very large donor who probably had a very large family wire and paperclip business and said, we got to do something because the Chinese are dumping all these very cheap paperclips into the U.S. So you'll see how these things can be very, very, very targeted. And again, based on protectionism. But that's not the only reason that tariffs can be used. They can also be used if the idea is we're trying to even an uneven playing field, where we're trying to right some wrongs in terms of what other countries are doing with respect to our exports or their imports. If we were to look at this particular slide, the slide talking about simple average tariff rate, you'll see the U.S. listed along with many other trading partners. And you'll see that on average, this is before this most recent bout of increased tariffs, the average tariff that the U.S. would assign on imported goods was a little over 3%. So think of that as a 3% bump in cost for anything that was imported in the U.S. Not significant, not hugely large or impactful. It was a small tariff nonetheless. But when we compare that to the tariffs that are in place and are affecting goods that we're exporting, the tariffs are quite a bit larger. For example, India, it's 17%. China is high single digits. So there's clearly somewhat of an uneven playing field. So using tariffs, using targeted tariffs, you can sort of even that out a bit, or at least put some pressure on other countries to perhaps reduce the tariffs on our goods, making it a little bit more of a free trade environment. But that's not the only other reason to use tariffs. Tariffs have historically been a source of revenue. And the U.S. also historically has used these things on occasion. Not so much in most recent history, but certainly on occasion. If we look at the second slide, which depicts tariffs as a percentage of total federal receipts, or in other words, what percentage of the income that the U.S. takes in is really coming from tariffs. And we'll see these days, again, before this most recent tariff bout, it was about 2%. Kind of a rounding error when you think of all the other resources and funds that are coming in from taxes, corporate and otherwise. But you'll see that in our early history, for many years, better than 100 years, the vast majority of the revenue that the United States received, that they would use then to form a military, run certain operations, control certain industries, or provide supervisement on certain industries. All of that was typically funded by tariffs. And at one point, 100%, well over 90% of revenue was coming from tariffs. And that slowly changed. And what really changed was back in just after 1913 and beyond. That's when Congress passed the 16th Amendment, which formed and established the federal tax system. And when they started taxing income, the need to start taxing imports dropped off. So as a result, you can really see this kind of correlation. There were spikes with war activity and military hostility, but generally the tariffs have been much lower now than they were prior to, and certainly much lower now than they were prior to having a federal tax system. So the issue is tariffs can be helpful, but it's very, very difficult to kind of thread that needle. How do you create change without creating chaos in the system, both economically as well as with respect to various markets? And as you can see here recently, based on the news of the last week or so, there are a tremendous number of ripple effects. As a further comment on this idea of threading the needle, I have another slide I'd like to share. But before I do, for those who are listening at home, hey, there are a couple slides that we're referencing here in this podcast. And I know if you're listening to a podcast traditionally, slides really don't help much at all. But I'll tell you what, all these slides are in our show notes. And if you were to look at the show notes and listen to the podcast, you'll clearly have a much better understanding of exactly what we're kind of talking about here. And I think it would be really helpful because some of these, a picture says a thousand words, and clearly these graphs, these pictures really better explain the concepts that we're trying to talk about. So this slide is actually what happened during Trump's first term. And if you remember, he was using tariffs at that point, particularly against China. And the slide talks about the market, the blue kind of mountainous ebbs and flows, or where stock market performance is. And you'll see at one point during the discussion of tariffs during that first term, the market dropped from peak to trough about 18%. In addition, over that period of time, we saw a lot of ebbing and flowing with respect to inflation. In fact, inflation at the beginning of Trump's term, before tariff talk, was about 2%. And where it ended after all this ebb and flowing with respect to tariffs was a little over or near 2.5%. It doesn't seem like a big move, but that's a 20% improvement or increase in inflation over that duration. So tariffs can be inflationary. They certainly were somewhat inflationary during Trump's first term. The big difference now versus then, we're starting with inflation a whole lot closer to 4% than 2%. And more importantly, we have interest rates today that are 4.5%, whereas back in Trump's first term, a 10-year U.S. government bond was trading at probably close to 0.5%. So the impact on these things can be a bit more dramatic this time around than they were during the first term. So the real key here is how do we avoid some of this disruption and this ripple effect that we typically have throughout the economy and a variety of different industries.
You're absolutely right that there's a huge ripple effect throughout the economy, the broader markets. So how should investors be looking at this, and how should they think about it when it comes to retirement planning?
Well, this is probably not the time to think, gee, I probably should have had a different strategy in place. This is just simply the time that you put your head down and you execute the strategy that we talked about before. And a lot of it has to do with kind of where you are in the accumulation cycle, where you are relative to retirement. If there's a 35-year-old listening today who has 30 years or so to continue to accumulate, they're not looking at using this money and they're not retiring anytime soon, doesn't make a bit of difference. They don't need to do really anything at all. Markets ebb, markets flow, markets go down. Eventually they come back up. And if you have a 30-year runway, there's a really good chance that there'll be plenty of time to dig out of whatever this thing becomes. And there's really no reason to change, nor is there any reason to lose any sleep over risk or volatility. However, if you're on the cusp of retirement, a couple of years away, or in retirement today, these are discussions that we should have had a long time ago. What is the risk profile? What is our time horizon? How important is downside risk protection compared to participating on the upside? For a 30-year-old, I understand participating on the upside, vastly more important than downside risk. I wouldn't think it's the same for a 65-year-old. So those conversations are things that should have happened before. But we're beginning to see where we have this ripple effect where it's not just affecting the stock market, it's affecting just about every technique, strategy that we typically use or are accustomed to using with respect to building out a portfolio. Diversification is great. I think it is still wonderful. That said, if tariffs beget retaliatory tariffs, you're going to see a lot of countries struggle. Vietnam, for example, is a purely export-driven economy to which most of those goods and services wind up in the West, specifically the U.S. Having a large tariff on Vietnamese goods and services are really going to hurt their local economy. Conversely, a weaker dollar as a result of tariffs might very help U.S. investors investing abroad because of the change and adjustment to the U.S. dollar. One of the biggest changes, things that really are not getting a lot of news and deserve to have a whole lot more talked about, is what's happening with respect to the bond market. Everybody talks about the stock market. All those well-dressed reporters that hold microphones up on all the various news programs, or the Dow's up, the Dow's down, the Dow's this, the Dow's that. What we really should be looking at and should have some degree of concern about is what's happening in the bond market, because the bond market is acting absolutely different than what we would expect. Interest rates are going up. Bond prices are going down. U.S. denominated bonds, those where there should be absolutely no credit risk, unlike a corporate bond that could have issues down the road if the economy really goes into a tailspin. Those should be supportive of their price, and yet those are getting hammered. Why is that? Is that because other countries that are facing large tariffs from the U.S. are starting to dump U.S. bonds? That could be horribly destabilizing. Is it the fact that tariffs have a tendency to be inflationary? And if they are effectively inflationary, are bond prices reflecting the fact that they're going to need higher prices to get compensated for a higher level of inflation? That could be the case as well. Is there some concern that some of the adjustments and changes that are being made today with the current administration may blow out our deficit and require even more government borrowing at even higher interest rates? And as a result, it becomes a risk-off transaction. Historically, when the stock market is in some degree of tumult, you typically have a safe haven with respect to bonds, and that's not the case, at least not right now. So where can one find safe haven? Well, diversity still matters. Real estate is down. Real estate's not down quite as much as the stock market. Gold is actually up. Gold is coming off of a really good year and is up 17+% year to date. On really bad days, gold is one of the few areas that's actually up, and that would help hedge out or reduce some of that risk. But these types of strategies, these types of techniques are things that really we should have been talking about for quite some time, not just today. And the way this ripple tends to work, it sort of works like this. You're going to see typically higher cost. Part of the reason is, given a higher tariff, somebody who's importing those goods and services either can hold on to that increase themselves, which will hurt their profit margin and hurt their stock price directly, or they can pass it on, and that becomes a higher cost. It can also lead to lower profitability. It generally leads to higher inflation. That might lead to a reduction in consumer confidence. Depending on the reduction in consumer confidence, we might have a huge change in consumer spending habits. They might not be buying imported Nikes and buying, Chuck Connor Converse All-Stars or whatever is still made in the U.S. if there is a tennis shoe made in the U.S. They might not be buying groceries at Kroger, they may be going to a lower price alternative. And those changes can lead to dislocation in production. Companies that have shuttered manufacturing will have to bring those back online. Other manufacturers where demand has moved past them will need to reduce. That leads to a change in the unemployment rate, which then affects the economy and affects markets as well. So when you look at tariffs, they fall into really two camps, those that are proactive and then those that are tend to be retaliatory. Retaliatory tariffs really can affect U.S. industries as well. In particular, the agricultural industry can be really hurt by tariffs that are put on goods and services that the U.S. is exporting. And so think of that as wheat and corn and certain meat proteins, etc. It can also have huge impacts on certain specific industries as well. That would be more from the standpoint of imported cost or the tariffs that the U.S. is putting on. On this slide, which depicts the value of the top 5 imported products and where they're coming from, you'll see these are huge industries that could be dramatically impacted by these tariffs. Obviously, motor vehicle parts, that's a big one. And you can see that to a large degree, they come from Mexico, China, but then other parts around the world as well. Computers, phones, a lot of the internal gadgets, the chipboards, et cetera, those are coming out of China. You look at crude production, to a large degree, that's coming out of Canada. And that would have a huge impact on the environment. The oil prices have been dropping as a result. And then when we look at cars, not a big surprise, all the OEMs here, think of that as Ford, GM, et cetera. They manufacture a lot of vehicles in Canada as well as Mexico and bring them over as completed vehicles. They also import parts as well, to say nothing of all the implants that still manufacture abroad. Mercedes, Toyota, they have plants here, certainly, but they also import finished goods to the U.S. So this has a huge impact on a lot of industries and a lot of people who are employed by those industries. But that's not the only place where tariffs impact. That's what everybody is talking about today. We're seeing that in the price of stocks, et cetera. But you also have to consider local and state governments, because they are dramatically impacted by this as well. On this very last slide, overall trade as a share of state GDP, we're looking at imports plus exports, or total trade, as it represents on a percentage basis total state GDP. And you'll see that the percentages vary quite a bit, as low as, say, 2% for Hawaii, as much as 41% for a state like Louisiana, where they do tremendous export of oil and crude. I'm domiciled in Michigan, and you'll see Michigan, it's 35% of our state GDP. That's a large number compared to most other states. So imagine if this gets disruptive. If we're no longer able to export, if the cost of imports start to rise, what impact does that have on state of Michigan sales tax? What impact does that have on state operations? What impact does that have on the education system and money that gets trickled down to local communities? So a lot of people think of tariffs as just affecting stocks, companies, stock market values. It can have a real effect on an awful lot of Americans who don't have a single dime invested in the stock market. So it's important to understand that as well.
So how should retirees and pre-retirees be thinking about these tariffs, and what, if anything, should they be doing?
Like I said before, I think that now is not the time to make a whole lot of changes. Those changes probably should have been made in strategy well before this point in time. I think it's important to have a conversation with your advisor. I think it's important to discuss how the portfolio is set up, what is the risk intent, and if there's any game plan in place to make some adjustments accordingly. Now, one thing that can be done, like I said, I wouldn't say this isn't the time to get religion and say, oh my God, I've got to be defensive. Again, that ship has somewhat sailed. It's time to execute the plan that has been in place for many years. But with the drop that we've had in the market, this might very well be a good time to rebalance a bit. This is a great time in taxable accounts to consider tax loss harvesting. We're a big fan of tax loss harvesting. Having accrued a loss available to us helps us create tax efficient cash flow that can be used in retirement. That's vastly important. If you sell something for a loss and you really wanted to hold that stock or that fund, remember you can buy it back after 30 days and still book the loss, which is hugely impactful. For accounts that would not require tax loss harvesting, you might want to look at the present allocation compared to what your targeted allocation was. This is assuming that you're in a kind of a static portfolio where forevermore it's always going to be 60-40 stock to bond or 50-50 or 70-30. And kind of look at what the allocation is today. And if that allocation is off by 5%, if you're targeted 60-40 and you're 65-35, this might be a good time to tweak and move and adjust a little bit as a result of that. That has less to do with risk management or less to do with de-risking a portfolio and more about just bringing the portfolio back to the long agreed upon allocation that the portfolio should have been managed at. Keep communication lines open and what the strategy is with respect to you and the advisor. At this point, it shouldn't be a surprise. There should have already been some degree of communication with regard to this. Not maybe necessary specific to tariffs, but certainly specific to the fact that, hey, market is down year to date. We're in the fourth month of the year, and the market really started selling off late last year. So what's causing this? What are we doing about it? Those are discussions that we should have had way back when.
And let me add to that, perhaps people should stay informed.
Absolutely. Yeah. In fact, that probably should be the first thing that people should be considering doing with respect to their accounts and their relationships with their advisor. There's going to be a lot of news from a variety of sources looking at and covering all points concerning DOGE and the effects on the economy and immigration and the effects on the economy and certainly tariffs and the effects on the economy. It's important to certainly stay informed, form your own opinion, but also make sure that your opinion is aligned with that of your advisor as well. Or if it isn't, for whatever reason, you understand that and you know where those differences are, because that certainly does have an effect on how the portfolio is managed, how it's structured, and what changes or adjustments are made. Nobody knows what the future holds in store. My experience over 40 some years now is these types of events are not the main attraction. What I mean by that is they often become the straw that broke the camel's back. There has been a fair amount of data over the last several years that suggests that the economy has been somewhat weak. It's not quite as strong as a lot of people had hoped or expected it to be. And when you have some of these unrelated events, and you sort of call tariff as somewhat of a one-off, it does have an outsized effect on the market, more so than tariffs themselves, because it just becomes this, I don't want to say self-fulfilling prophecy, but it does become the reason to start recalibrating and repricing. So by all means, stay informed, communicate directly with your advisor. And if you have any concerns or questions, by all means, raise those, form a strategy going forward, and then just execute. By doing that, it should eliminate a lot of stress, or at least eliminate some of the stress you might be feeling, because you know that there is a game plan. This has already been articulated. And at this point, all you're doing is following the plan that has been set up in anticipation of what news flow is occurring presently.
Jim, you've offered us so much food for thought today, including the fact that, remember, tariffs may begin as global policy decisions, but their ripple effects can reach all the way into your everyday expenses and your long-term financial plans. Now, in today's episode, we unpacked what tariffs are, how they can stir up market volatility, and while understanding their impact is important for both pre-retirees and retirees. Now, as always, staying diversified, tuned into the big picture, and focused on your long-term strategy can make all the difference. If you're unsure how shifts in global trade might be affecting your retirement portfolio, consider reaching out to a trusted financial advisor for a review. And if you're looking for guidance, Jim's team at Kaydan Wealth Management is always happy to help. You can visit www.kaydanwealth.com to learn more or book an appointment. If you found this episode helpful, please subscribe so you don't miss future episodes, and share with someone who could benefit. And follow at Kaydan Wealth on social media. Let us know what you think in the comments. Your feedback and topic suggestions help us improve and make a bigger impact. And thanks for supporting our show.
Thank you for listening to The Retirement Engineer with Jim Kruzan. Click the follow button to be notified when new episodes become available. Visit our website at www.kaydanwealth.com or give us a call at 800-638-6900. The information covered and posted represents the views and opinions of Jim Kruzan and this episode's guests, not necessarily those of Kaydan Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.